So anyway, assets. Before we get into assets, it's not a story, it's actually an article I saw today, some of you may have seen it as well. I thought it was worthwhile bringing up because we've talked a little bit last week about profitability and why it's companies, their incentives potentially push profit up. But this article today actually speaks very clearly to why sometimes really high profits are problematic. So you may have seen CBA had results being announced and they had an $8.68 billion profit, which is not a small amount of money. And so this article and the link to it, I mean, it's on the Herald website. It's also, we put it out through the subject's Twitter account, which is on the face of UTS Online. So if you are interested in having a read of it, the links are there already. But the headline sort of picks it up quite clearly, this idea that CBA's profit is too big for political comfort. And that's this idea that, I mean, the whole point of companies is to make profit for their shareholders, and I don't think in a way anyone's arguing that. But then as you start sort of becoming more and more profitable and sort of very, very profitable, questions start to get asked about, are things too good for you guys? Are there sort of things that need to be done to sort of pull that back in a little bit? Now, we saw that with mining companies, and when the previous government tried to introduce the mining resource rent tax, which didn't really work out for them. At the moment, there is a financial services inquiry looking at not do banks make too much money, but just sort of the financial services industry more broadly. And it's these sort of things which can sometimes colour perceptions about what happens in those sort of inquiries. So yeah, I mean, it's worth reading that article and just being aware that sometimes making a heap of money is not necessarily a good thing for companies, because what can happen is it can potentially impose real costs that were not there previously. So anyway, I thought it was relevant and it was from today. So what we're going to be looking at, we've moved off revenue and expenses. And look, there are expenses and things which are important, as we see in here, and even profit impacts on the positive side in relation to assets. But what we're going to be looking at is what assets are, what information they provide, why those figures potentially can get adjusted, and then roll into the regulation, and we start looking at the various requirements around the different types of assets, or at least some of the different types of asset standards that we have. There are a heap of asset standards. We will be looking at a number of them over the course of the semester, and we're just looking at a few today. So a balance sheet, it's got assets, the liabilities aren't there, just to make it somewhat legible, although I think up the back of the room it may be difficult, but it's worthwhile going and having a look at these. If you can see, you're probably having to squint a little bit to see it, but down the bottom here, property, plant and equipment. So this is Qantas's balance sheet, roughly $14 billion of assets, $14 billion worth of property, plant and equipment on a balance sheet of about 20 billion. So in terms of importance, property, plant and equipment is about 70% of Qantas's assets. So it is not an immaterial item that we're dealing with. If you look at the next largest ones kicking around, cash and cash equivalents are nearly $3 billion. Receivables, about 1.5. Then rolling down into intangibles, which we'll look at next week. So, assets very much, property, plant and equipment is very much the biggest thing which is kicking around out there. So it is important that we have a look at it, and that's what we will be doing. So what an asset is, and the framework is important in this case because we will be looking at multiple different types of assets over the course of the semester. So this gives you an overarching sense of what an asset is perceived to be from the framework's point of view. So what the regulators see an asset as defined as. And it pretty much, as you can see, three things. This idea of a resource which is controlled by the entity as a result of past events and from which future economic benefits are expected to flow. So let's take those three ideas and break them down a little bit. So firstly is this idea of control. Now control isn't necessarily ownership. If you're doing ABC or if you've done ABC, you've come across subsidiaries, and subsidiaries are controlled by the parent. They don't necessarily have to be 100% owned. They don't even have to be majority owned. You can have situations where you have subsidiaries which have a very small, which you have a very small ownership stake in, but you get control by other means. The flip of that is, and I've seen examples, and there's well, it's not a subsidiary of Telstra, but if you look at Telstra's annual report, one of Telstra's There's a company which Telstra owns 100% and is not a subsidiary of Telstra because they do not control it. And if you go in the notes, you can see why they say they don't control it. So ownership and control aren't necessarily the same thing. More likely than not, they are, but it's not all the time. So this idea that you're the one that's going to benefit from it, and you may potentially, stop others' access to that. Something has to have happened. You can't have an asset when you're going to buy something in the future and that's an asset of the company. The event has to have already occurred. And that makes a lot of sense. And this idea of future economic benefits is you are going to get some benefit. It isn't, like when you think of it's an asset, it's something beneficial to you, that's the sort of idea. It's whether it's by some sort of income stream, whether it's by some sort of final sale, you are going to get economic benefits from having this thing. So if you think about if you own shares, how do you make, from an economic point of view for the holder of those shares, how do shares benefit you? What are the ways you make money off shares?
Dividends.
Yeah, you get dividends. So you got that income stream.
Oh.
Or you could sell it, or you can get the capital gain, well hopefully capital gain, depends on what's happened, or you could get a capital gain and you can sell it. Same with property. If you've invested in property, you can get the rental returns, and then you can get potential capital gain at the end. It's this idea of you get money over the life of the asset, or you get money or benefit from selling it at the end. And that's pretty much this idea of future economic benefits.
Oh, but just one quick question.
Yes?
A lot of assets like car and computer, you actually have to pay a lot of expense for it. Car, for example, you have to pay for petrol and insurance and maintenance as well.
Yep.
Then when you sell it, you won't be able to get the price that you actually paid it for.
Yeah, absolutely. Well, yeah, you're probably not.
So I was just wondering that, is it going to be a future economic benefits or?
Well, yeah, I mean, look, a car, it's not just, I bought my car 5 years ago. It's certainly not as much as, I'd like it not to be the case. It's not worth the same as it was when I bought it. But I've still got a benefit. I'm not using it from a business point of view, but I still get a benefit from having the car because I get to use it and I get to drive from point A to point B. So just because it's not going to be worth the same, that's almost a value. It still gives me benefit from using it. And there is a cost to that. And we'll look at that as we get into property plant, the actual standard in relation to that. But yeah, just because the value changes, or I suppose the value of that asset drops down doesn't necessarily mean it doesn't have a benefit for it. Yes?
Do all three of those have to be satisfied for it to be an asset?
Okay, well, first of all, good question. I suppose yes and no. This is actually just the framework. So this isn't, when we look at the standards, they'll actually have this is what this particular thing is. But I mean, from how a standard, from what an asset is defined by, it has to have those elements. That doesn't even mean, and we'll go into the next, it leads into the next bit, which is recognizing. So just because you have something which meets all those definition criteria doesn't necessarily mean you get to recognize it. And again, this is how the framework thinks you should be able to do it. This isn't when we actually open up the standard and says, okay, this is property, plant, and equipment, and we can put it on our books. Then we have to look at those specific elements to see what's going on. And you'll actually see these terms come up as we go through the recognition criteria. So, and that's where the framework is quite useful. This idea of probability and reliability. So say we've got an asset, say it meets those three things. Doesn't mean from the framework point of view we can bring it on. Then say, okay, we've got these things and we can come up with a few examples later on. So we meet them, but maybe those benefits aren't probable. Maybe, and actually, we'll use an example right at the moment. Imagine this is a lottery ticket. So I've spent money on it. Now let's say, and I know because they actually used, when they were talking about what an asset is, they were using a lottery ticket as an example. It works for what we're trying to do here. This could win me $20 million. Let's say, I think there is a draw coming up soon for 20 million. Either it's just happened or it's coming up. Anyway, so say this ticket could win me $20 million. I control it, it's my ticket. Although you do hear about people where someone's giving you some money to go off and buy a ticket and they buy the ticket and they win and then there's a fight about who owns it. But I bought the ticket, I own it, I control it, there is a past event. Yes, there are future economic benefits from it. Possibly. I could be holding a $20 million winning ticket. I could get 50 bucks. I could be right down the bottom end of it. I could get something from it. But I'm probably not going to recognize it as an asset because the probability of this actually leading to some sort of beneficial outcome for me is slim to none. Like the odds of winning the lottery are tiny. So I couldn't say, yeah, this is an asset of $20 million. I control it and all the rest of it, but I'm not going to win as much as I would like to. I can measure the cost though. I know how much the winning ticket is. You could even work out, what are the odds of, actually, but then some of that bleeds in together because you could probably work out a weighted average value of that ticket, working out the different outcomes from it and come out with a number which would probably be pretty close to zero. But then when you start to talk about different assets, and I'm hoping that's the next slide, it is. I would say, does anyone recognize who this person is? But I'll put his name up at the top. But when I went over to England, I still don't really follow, I'll call it soccer just because that's what I've always called it. I never really followed it, but they're mad for it. Like you get on the tube in the morning, you get on the tube in the afternoon, there's just papers all, it's like 50 pages about the thing. I went along to a match, I wasn't really overawed by it, but Gareth Bale from Tottenham to Real Madrid, £100 million transfer fee. So Real paid Tottenham £100 million. That's not what went to him. He's getting something like 15 to 20 million pounds a season. A tough life for some. But you hear about, he's an employee of Real Madrid. Now the reason I bring this up, one, I think I may have mentioned this earlier, a number of sports teams are listed. So I don't think Real is, but Manchester United is listed over on the NYSE. The Brisbane Broncos are listed on the ASX here. There are a number of publicly listed sporting teams, which means, forgetting about the US ones, but the Brisbane Broncos have to use Australian accounting standards. Now, you also hear a lot of organisations talking about their people are their biggest asset. But are people from an accounting point of view, what we see in the framework, are people controlled? Like, is Gareth Bale controlled by Real? No. I work for UTS. Am I controlled? You guys work for I'd imagine most of you here work for someone. Are you controlled by that company? So it probably falls down there, because I don't think many of us, yes, there are some contractual obligations we need to meet, but most of us can walk away. I think pretty much everyone can walk away from their job. So I don't think we're necessarily controlled. Do we provide our employer future economic benefits? Yes. I'd say we probably do. I'd hope so. Does a footballer, does he provide economic benefits? They just won the Champions League, I think. I think they didn't win their local competition, but they won the Champions League. I don't think Wales went in the World Cup, so he's not really beneficial there. They sell merchandise, they'll sell more because of what he's there. You look at, I'll bring up the Waratahs again, that has had a definite positive impact on the sport in this place. So performance does lead to outcomes. Can you nail it down to one particular person? Maybe, maybe not. Has the transaction happened? Yeah, it has. I mean, the thing is, it's not necessarily talking about, and the interesting thing with Gareth is, and a lot about EPL transfers, we're not necessarily talking about the weekly wage that's happening. What do you do with that $100 million transfer fee? Because that's not like my salary. That's not like your salary that's happening. Real have paid Tottenham a huge chunk of money for this. So how would do you think that Real would account for that?
According to the contract.
Is that?
According to the contract.
According to the contracts? But from an accounting point of view. We'll actually talk more, have a think about it over this week, and we'll actually look at it a little bit more when we get to intangible assets next week. So the information content of assets. Now, last week, look, we just saw that article about Commonwealth Bank. Companies and media focus on profit. It's a pretty easy thing. People go, oh, they make lots of money. You often don't hear about assets so much. But it is important that those are looked at. Now, what this is primarily getting at is this idea that if you have a property, and think about think about this in your heads. If, in a few years' time, I mean, maybe you're currently looking, maybe you already own, but imagine in a few years' time, you're looking to buy some property in Sydney, and it's obviously slightly difficult to do so. Are you interested in the price of the property you're interested in? Are you interested in the price that was paid for it 20 years ago? Or are you interested in the price, the estimate of what it's worth now? Yeah, I mean, and this is that whole sort of relevance versus reliability argument, that from a user's point of view, if we're trying to make economic decisions with this stuff, you'll be happy with a little bit of error in terms of what's happening, because with an estimate, you'll never be spot on. But if that property was worth, we know exactly it was $100,000 20 years ago, and now it's $800,000 roughly, that 800 is a much more important figure for us, because that's roughly what it's going to cost us. The 100 doesn't really, the 100 might be used as an input into the valuation, but it's the 800 which is the important number. And that's what we actually pick up in this study. It's a few years ago. Picks up is that the market does pay attention to asset revaluations, and they do seem to sort of react as a way that you'd expect. So if there's an asset revaluation upwards, you'll see stock price move that way. If there are revaluations pushing things down, you'll see them go that way as well. So there does seem to be some level of information content in assets. And that's, in a way, ties back to what the regulators see accounting is for. It's for people to use it to make decisions around investment. That's primarily what they see it as. Depends on your housing situation, but that could either be a really awesome looking graph or a really scary looking graph. I think for most of us, probably more the latter rather than the former, but you can see things and assets change in value. And what we then need to be concerned with is how we deal with that change in value. Now, the reason I put this back up is, if you remember back to last week, and it was only a week ago, so hopefully you can remember back that far. But if you remember back to last week, what revenues and what expenses were from a framework point of view. So revenues were this idea of an increase in assets, and expenses were this idea of a sort of depletion of assets. So if we have an asset which is sitting there on our books and it's now worth more, but we have no intention of selling it, on one argument, that is income, because it is now worth more. That asset is actually worth more. But if you come back to this chart, when we looked at revenue, we haven't received cash for it. We haven't sold it. We haven't even received an order for it. We're just holding it. We're holding it, we may well be using it, but it's sort of this idea that's picking up income because the asset value has increased. But on the other hand, we haven't really done any of those things which we looked at last week. So should we realistically be recording some sort of profitability for it? And so those are questions which the regulators have to deal with, and that's what we'll look at a little bit later on. So function influences form. So we had, it was Nick buying the car last week, 2 weeks ago, wasn't it?
Yes, it was.
It was. How is your Toyota Land Cruiser?
Still a long way away.
Still a long way away. Getting there though.
Yes.
All right. So you got the slide, we're just moving off it for a moment. So management have incentives to, they have incentives, whether they do or not is a different thing, but they have incentives, and there has been some evidence that the higher your leverage, you're more likely to boost, to boost asset values. So what did you have to borrow? You had a $40,000 Land Rover, wasn't it?
Yeah.
Yeah. So I think it was assets. We ended up, I think it was what, liabilities of 30
That's right.
and equity of 10. So if we're doing liabilities on assets, that gives us 75%. So from memory, we had the two Danielles that were lenders. I think it was Mike. I'm surprised I can remember that far back. Anyway, so we had 75% leverage by this point. Now imagine that last little tip. We can't, I'm going to have to try to pick a number that I can calculate in my head. Let's say, because Daniel, you were the second. No, standard. So say you didn't want him to, I can't remember what you put in, but let's say you didn't want it to go above 60%. So as soon as he's borrowed from Michael, it's gone to 75%, and that's problematic. So one way is he just doesn't go off and borrow that extra money, and that keeps it below 60%. You could get rid of some of this debt, or we could have a situation where you just adjust, you have a revaluation of your assets, you do something with the existing assets from an accounting point of view, you don't do anything real with it. So let's take this up to, what's the number I can work out? 60. There we go. So, this is obviously not that realistic, but you get the drift from it. So now we're at now we're at 50%. So by making an adjustment, or, having a revaluation of his assets, and that's pretty substantial given the going from 40 to 60. But if this idea that if this adjustment was to happen, your leverage suddenly becomes 50%, and that means you're in the clear in terms of that 60% debt constraint cutoff. And that's not a real thing that's happened. That is just changing the value from an accounting point of view of those things. It may be done some other way. It may have been to get this, you had a depreciation life of a certain amount, and you just extend that depreciation life, and that will reduce the amount of depreciation that happens each year. So, and I know, for example, and I don't think they did it for this reason, but Qantas changed their depreciation life about 2 or 3 years ago, and it was disclosed and you could see the effect from it, but ultimately it has an effect on these recognized numbers. If management use return on assets, so if we have, and there are different ways to calculate it, but if we just have some level of profitability and some level of assets, and you can do it sort of dealing with tax and all the rest of it, but if we just do it as a really simple idea that sort of your profit over your assets gives you a return on assets of 10%, if your assets weren't actually 100, if your assets were 50, for example, again, not that realistic, but the point still holds, you can boost your ROA to 20%. And again, it may be that you don't have a revaluation going upwards, or certain things don't come into effect, and you can change that quite substantially. Now, based on that, some companies do, and I know Qantas at least used to, but if you've got a management team which are compensated based on ROA, then there may be sort of incentives on the margins to just, not necessarily to fiddle just with that, but also to affect your return on, to affect your asset figures. Lastly, if we spend money, pretty much, we can record it as an asset or record it as an expense. So if you record something which is meant to be an expense as an asset, you're going to boost your assets, you're going to reduce your expenses that year, which is going to mean you got an increase in profitability that year. And as easy as that sounds, companies have done that in the past, literally, and we'll see some examples later on in the semester, and you're not talking small dollars. Like, you've seen billions of dollars which have been reclassified as assets. And, they got away with it, at least for a little bit. So there are temptations to play around with your asset figures. So is there a role for regulation? Yeah, there absolutely is. And I know we've gone over it again, but it's useful just talking about it and discussing once more. It is to try to just limit what management do in terms of the available options that they have to report in the way in which they would like, because we know that there are incentives for them to do this. Does every company try to sort of play around with things? No. But the incentive or the motivation is there. Right. So AASB 102 inventories. Do you cover, in first year, I know that may be a little while back for some people. In first year, when you do inventory, do you cover it? I know you deal with inventory, sort of direct materials, direct labour, overheads in management accounting topics. But when you do like FIFO weighted average, all those things, is that first year, is that the like accounting A or accounting for business decisions A? A. So in B, you don't really cover inventory. So this is going to be going back a little while for most of you. Okay. So inventory, all that we're doing here, if you can kind of remember back to some of that, is this is in a way no different from what you would have done back then, for those that can remember it. It's just codifying some of the things that we've come across. And there are a few instances that we need to discuss. So the primary issue here is what gets recognized as an asset and what gets carried forward. So it's what comes on the books and how it stays there and then how it comes off. Because ultimately, I would say pretty much everything that you spend and comes on the books as an asset will go out through the profit and loss statement at some point. There is a caveat to that which will show up in a little bit later, but pretty much everything that you spend will go out some way. And all that we're trying to deal with is how does that happen with inventory. So what inventory are? You go into Woolies, you know what inventory is. It's basically everything they've got in there. Now, that is the first bit. So this idea of held for sale in the ordinary course of business. If Woolworths sell off land, that's not part of their ordinary course of business, so land wouldn't be counted as inventory. So it's just what they regularly do. But for different companies, that may mean different things. If you're Qantas, a plane is not inventory because that's not what they're in the business of doing. But if you're Boeing, then planes are probably going to be inventory because that's what they're selling. In the process of production, so that's work in progress, materials or supplies, direct material supplies. This is important, and we're going to look at this in a little bit of detail in a moment or two, and then it actually is the basis for the idea of asset impairments. So there's a whole standard on this, which pretty much every other asset deals with, and that's what this idea is. So what it is inventories are carried at the lower of cost and net realizable value. And we'll talk more about that in a moment. Now, I don't know about you guys. Well, actually, this is probably more speaking, I could be wrong here, but this is probably more speaking to the guys in the room more so than the ladies. I don't like going shopping. I don't know about you guys. I don't like spending time going shopping. It may sort of become apparent in my dress sense. So most of my shopping happens pretty much when either over in the US or online. Now, I go running a little bit, and I know the shoe. I know exactly the shoe model, make, size, all the rest of it. You go in a Rebel, and that's like $200+. It's a pretty hard shoe to find. You can order it online and get it shipped from the UK to my door in less than 7 days for less than half the price. So this whole thing that Jerry Harvey was banging on about a year or two ago, that it's a GST threshold which should be lowered because it's that extra 10% and that's why people aren't buying in-store and they're buying online, is a complete furphy. It is because it's like double the price to buy it here. Anyway, so if I buy these shoes and they're $100 to get them, $100 to actually buy them, and then $10 to get shipped over. If I'm doing my accounting like this and I'm holding them as inventory, say, actually if I'm holding them pretty much like any asset, because most assets, the costing works like this. I don't go debit shoes asset 100, debit shoes asset 100, debit shipping expense 10, credit cash 110. I'll just go debit shoes 110, credit cash 110. Everything that you spend on an asset to get it to where you need to use it gets included. And that happens with inventory, that happens with property, plant, and equipment, it happens with intangible assets, it happens with pretty much most assets where you have a costing involved. You include everything to where you get it to be. I could skimp on the $10 shipping, but then I'd have to go to the UK to pick them up, which is not really worth it. So that is an inherent part of what you're doing with that asset. If you can figure out what the asset is, so jewelry or anything, very specific items, and you could argue as technology improves, you can much better identify exact things. But if you can't identify, or if the items aren't interchangeable, you can actually specifically identify them. You cost them that way. Otherwise, you use FIFO or weighted average. Now, you've got the asset, you brought it in. So I've got these shoes. Let's say I'm a retailer of shoes. I've got them on my books. Cost of goods sold is the expense in relation to it. So when you sell them off, that's when the expense comes onto the profit and loss statement. So you don't have an expense when you buy the shoes and then just do nothing when you sell them. You have the expense, you have them as an asset, and then you expense them out as you sell them. Alternatively, when it's written down, that's the other way in which the assets, which in the inventory comes off the books and into the profit and loss statement. So we're going to talk about write-downs in a moment, but I need to ask, because I'm hazarding most of you guys are well, a little bit younger than I am. I need to ask your opinion on something, because I saw it happen. It sort of became really big last year. I didn't understand it. Maybe because I'm old, maybe just, I don't know fashion. Onesies. Why? I don't know. Like, I actually, my 4-year-old has one. I don't, but yeah, I just saw like grown people walking around in onesies. Saw someone in an exam I was at last semester in a onesie. I was like, really? I don't get it. But say, for example, are they still like, I know it was a big thing. Is it still popular now?
Not really.
Not really.
Sort of.
I don't know. What's that? Never really bought into it? No. I don't know. Let's just, for argument's sake, say it definitely did seem... Library? Somebody else mentioned that this morning, so it might have been the same person. They've just been spotted by lots of people. What's that?
I saw 2 people wearing that in the library.
They weren't hanging around together, were they? Okay, we'll leave that alone. I was going to say there is a name for that sort of thing. So let's, for argument's sake, say that fashion trend, I'll use the word fashion loosely here, has come off the boil a little bit. And so you've had a retailer, they stocked up on all these onesies, and for argument's sake, they were retailing for $50 and they bought them for 30. And now, because no one wants to buy them, everyone's coming to their sense, the price of them has dropped to 25. That's a situation where the net realizable value has declined below cost, and you would have a write-off of that. So it was cost to the retailer of 30. It is now the net realizable, what they can sell it for is 25. It has come off, and you have a $5 write-off. I'll pick up the item by item, and I'll have to draw this up because this is also an important point. Now I can't use a onesie because I need 2 items, so I will. As you can see, I excelled in art in school. That is a shirt and those are pants. Don't worry, there'll be more later on. So we don't need to worry about the selling price, but say the cost of these to the retailer. So this isn't the retail price, this is the cost for the retailer actually buying them. So let's say 30 and 20 say, and the total is 50. So initially this is the cost, net realizable value for these items. So for whatever reason, the net realizable value for the shirts has come down to 25. The pants, the selling price was much higher, it's come down a bit, but it's now down to 22. So we got -5, we got +2, we got -3. What the idea, and if you've got the slide in front of you, usually item by item, so paragraph 29, is you don't do something like this where you aggregate out those effects. What you're trying to do is isolate as much as you can. I mean, obviously, if you've got lots and lots of things, you've got to figure out how best to do this. But this idea that this has come down, this has gone negative. In this case, net realizable value is lower than cost. But in this case, net realizable value is higher than cost. This is the cost. You're not going up to 22. You're keeping it at 20. So we don't have a -3 effect. What actually happens is this would get done at -5, and this just nothing would happen. And so in total, you'd actually have a -5 effect. So you'd actually bring it down to, like in total, you'd have $45 of assets, shirts at 25, and pants still at 20. So that's this idea of item by item. And if you've got the sheet, what you'd end up seeing is a debit loss of 5, credit inventory of 5 to pick up that impact, and we don't worry about what's happening here. Now, just to save flipping backwards and forwards, if you've got the next slide, what happens if there's a reversal of a write-down? What happens if, for whatever reason it occurs, the Australian public has a collective just loss of their senses, and onesies become popular again, and people start buying them, net realizable value goes up. In that case, if the circumstances that cause the write-down have lifted, people realizing that not great, to okay, they're okay again, then you can basically reinstate what happened, but you're limited to the original write-off. So say if for these, because we don't have to worry about this now, but say for these, the net realizable value the following year became 34. So currently on the books at 25, because we've come down to that. Net realizable value the following year, things have changed, it's come up to 34. We can't go all up to that, up to there. We've got to go up to what was originally the case. So we can come up 5. So that's that idea that you can come back, but you're limited to the original write-off. And the very last point to make there is it's not a gain. It's going to be treated as a reduction in the amount of expenses. So you're going to have cost of goods sitting there anyway, because you're likely to be selling other things. You just are sort of lowering that cost of goods. So in terms of disclosures, and if you're doing the bonus assignment, I just got told by Margot that someone has actually already finished, which I find quite surprising. Anyway, they're obviously sort of well planned out. But if you're looking in the notes, you'll see this sort of information about inventories, what policies they adopted, how much the carrying amount is, how much was expensed through cost of goods sold. But I reckon if you're looking as an analyst at companies, it's probably these 3 which are the most important, because that's looking at, if you start to see inventory write-downs, that's telling you that the stock that they hold, the inventory that they hold, they are having trouble shifting because something's changed in the marketplace, and that's having an effect on what they're selling. And I'm pretty sure that's an important thing to keep an eye on. So if they're having write-downs of inventory, you'd want to know how pervasive that is, whether that is signaling a shift in terms of what the market wants, how long that's likely to last for. Which is where, and this is part of the standard, you'd want to know what those circumstances are. And so they have to include it in the disclosures to the notes. I'm pretty sure, though, if those things were happening, you're going to see other management assertions being made about them and sort of what's going on. But that is important information for someone to know about what's going on with this company, or a company. Now, just to finish things off before the break, I just want to do something a little bit different, and it's something we'll tend to do over the course of the semester. And just to bring in an example, sort of a mini case study, if you will, of situations where companies probably haven't, it's mostly going to be companies. There may be situations where it's an economic trend or something's going on, where companies have done some funny things with their books. This one does relate to inventory. So what we're going to be looking at today, and I'm going to need your help if you've, with some of this, because I want to get your sense on a couple of these questions. What we're going to be looking at is a situation, it's been written into a book. As you can probably tell, that book is quite old. So it's going back a little bit, but it's an interesting one to have a look at. So it's called The Great Salad Oil Swindle. So what the hell am I talking about? So this was a company in the US called Allied Crude. Now what they dealt with was they basically sold vegetable oil, various sort of things, salad oils, vegetable oils. And it was a massive scandal. This is going back a long way, but it was a massive scandal in 1963. Now you sort of look at that and go, losses of 150 million. Christ, that was what Gareth Bale was sold to Real for. I mean, that doesn't seem like all that much. But in today's dollars, that's over $1 billion in losses to the banking syndicates that lent them money. So this is where I need you guys to think about this a bit. So the issue was, in this particular company, what they were able to do is, inventory for them was a substantial part of their business. So, no. Inventory to them was a substantial part of their business. And they were actually able to obtain, a reasonable amount. If you look at that, today's dollars, over $1 billion worth of loans based on the valuations of their inventory. And the inventory was mainly oil. Now, no bank is generally going to lend that amount, or even a syndicate is going to lend that amount of money without double checking that you actually have oil. Because you're not going to lend on just on a promise. So they had inspectors go out, and they had inspectors checking the ships that were sort of shipping this oil around and checking the tanks on the ships and on the docks and wherever they had these oil stores. So they climb up and open up the tank and put a dipstick in and whatnot and check that there was actually oil there. These are big, big tanks. But what is a physical property of oil which may be relevant in this situation? It sits above water. It floats. So what do you reckon was actually in the tanks? It was water. They literally filled the tanks with water and put enough oil over the top so when those tanks were checked, there was oil. And that's what they borrowed the money on. Now, obviously, if you don't have any inventory to sell, there is going to be a point in time where you're just not going to have money rolling in. So you're just not going to have revenue, you're not going to have cash, you're not going to be able to repay the loans. And it all kind of fell apart for them. But yeah, valuations in inventory holds, are an important thing, and people do pay attention to it. Maybe they should pay attention to science class when they were checking this stuff, but there you go. On that note, we'll take a break just for a couple of minutes and get into property, plant, and equipment. Welcome back. Now everyone's stretched their legs, or some people have. Property, plant, and equipment. So property, plant, and equipment is a pretty major part of most companies' balance sheets. Like even if you're service related, there will still be generally quite a large amount of property, plant, and equipment sitting there. So what we're interested in is basically how do you bring those assets on, how do you measure them, and then how you sort of keep dealing with them over the time that you use them. Because we already know that these things change in value. Plus, we've also got to figure out, we spent this large amount of money on something. How do we ultimately get that spend into the profit and loss statement? So this idea of depreciation. So in terms of the scope, you apply it in accounting for property, plant, and equipment, except where another standard requires or permits a different accounting treatment. So what property, plant, and equipment is, property, plant, and equipment is or are tangible items. So firstly, they've got to be something tangible. We'll deal with the intangible items next week. They're held for use in the production or supply of goods or services. So if you have something which is helping, you've got a piece of machinery that's producing something, that's going to be property, plant, and equipment. If you've got a building like this one, which is used in the supply of services, that's going to be property, plant, and equipment. If it's being used for rental to others, so it might be a car rental place where they have cars and they rent it out on a short-term basis to other people. Those cars are more likely than not going to be property, plant, and equipment. Or you use it for maybe your head office building or something like that. So then you're talking about admin purposes. Not just that though, but they're expected to be used for more than one period. Now, so we're starting to move into non-current assets, but this is an important word here because something could be classified as property, plant, and equipment, and you could buy it and then sell it off in the same year. Just because you held it for less than one period doesn't mean it wasn't property, plant, and equipment. What this is turning on is, I suppose, management intention around that particular thing. So if they intend or they expect it to be used for more than one period, that satisfies that definition. And we'll actually see a little bit when it comes to financial instruments, when it comes to various other things, that you can have the same item, and you could be some sort of financial instrument, whether it be a derivative, whether it be a share in a company, whether it be a bond that you've that you've invested in, it depends on your intention in relation to that item. You may intend to hold that bond and just collect the cash flows from it. You may intend to be using that for trading purposes. It depends on what you intend in relation to it. That affects, or potentially could affect, how you end up accounting for it. So sort of intention and expectation start to become quite important things. So for initial recognition, and check that out, and this kind of comes back to your earlier question about what things we have to sort of tick off. So if we look at this to be brought on, it's an asset. The cost of an item of property, plant, and equipment shall be recognized as an asset if and only if there are probable future economic benefits, and those will flow to the entity, and the cost of the item can be measured reliably. Now, I suppose embedded in that, it doesn't talk about a past transaction, but you kind of have to have a transaction for it to be sitting there. It's got this idea of we've got measured reliably, we've got future economic benefits, we've got probability. I suppose embedded in all of that is control, because you spent money on this particular thing. Initial measurement, you measure it at cost. And cost, so this is pretty much the same idea as what we saw with inventory. So we've got it, we measure it at cost, and cost includes cash or cash equivalent. So if you've actually paid for it, then that's what you put in. Or if you've paid for it with something else, you might have paid for it with equity instruments, you might have paid for it giving them some sort of other asset. You're looking for the fair value of what you provided. Purchase price, anything else to get there, really similar to my shoes being brought over. You also include an initial estimate of dismantling and removing the item. So that's almost gets brought in as a provision. You haven't actually spent that money, but you are estimating what it's going to take to basically dismantle the whole thing some future point in time. And so that actually gets included there. The cost of an item of property, plant, and equipment is the cash price equivalent at the recognition date. So then, it depends on, I don't know how tricky we'll get with this sort of stuff, but what happens if the way that you're paying this item in terms of, is it all paid up front? Is it paid partly now, partly later on? Is that, how do those sort of arrangements start to work out? I wouldn't say are there contingent payments in this, because that's starting to get beyond the scope of what we're doing. But it's not just simply, here's $1 million and go buy something. A lot of arrangements are structured a little bit more tricky than that. That's not a good word. But they're a little bit more complicated than that. So once we've got something, so we've spent $1 million, and we've got an asset, and it's on our books, and we've debit asset or debit property, plant, and equipment, credit cash, and we've got it there. Then what do we do with it? Because we know this stuff changes in value. But even before we get to changes in value, we need to deal with depreciation. And again, this is, I suppose, something from my knowledge. Is depreciation mainly covered in accounting the A subject or the B subject, or in both, or neither? It should be
More A.
more A. In both. Okay, so it's in there. So, so we'll go through. So you should be fairly aware of what depreciation is all about. So first bit is when you look at an item, and we'll use a plane for example. You depreciate items separately when they're substantial to the entire cost. So for a plane, look, I'm not an engineer, but the engines will generally get depreciated separately from the fuselage. There's probably other things which get depreciated separately as well. So it's not all just in one hit. You don't go, here's a plane, depreciate it. You figure out plane and figure out the different components that need to be done. And you don't have to break it up into hundreds of little things, but generally there'll be a few different components in there. Normally what you probably got used to, although I'd imagine they would have talked about this in first year. Normally you'll see debit depreciation expense, credit accumulated depreciation, but that's unless you're using that asset for something else. So if you're using that asset to build another asset, so if you're using that piece of machinery to make something, then the cost of that asset will actually be apportioned out and placed within the thing that you're making. Because remember from 102, what cost gets included in inventory, it's all the cost that basically you've got to making it or getting it to where you want to use it. So if you've got the bottling plant at Coke that's having, making Coke bottles and making various other things, that would in some way that overhead would be spread out and into the various inventory that's being produced. So that's what that idea is picking up. Sorry, I'm just going to have to ask. Can I just get you to? Thank you. So the depreciable amount. So the depreciable amount is what you allocate out, and that's important. Depreciation is not a value thing. Depreciation is just taking the amount of money that you spent, so that $1 million that you spent on the asset, and then just simply allocating it out over the useful life. That's all that it is. So most people were used to depreciation being Nick taking out his $40,000 Land Cruiser and it dropping 30% as soon as he drives out the door. That's not depreciation from an accounting point of view, which I imagine you guys are well aware of. So all we're doing is taking Nick's $40,000, figuring out how long he's going to use that Land Cruiser. Now, those things are pretty indestructible, so it might be some time. And just going, of that $40,000, let's allocate it over its useful life. Now, that useful life, we'll just jump down here for a sec. That could be a number of years. It could be a number of kilometers. It could be some other way, to measure it. But generally for a car, it'll either be years or kilometers. And then you just go, well, that 40,000, we expect it to be used for 1 million kilometers. Let's allocate it that way. And just for each kilometer, for each however many kilometers you get done in that particular year, that's how much depreciation gets done. Or it could be done in some other way. So that's the useful life. It could be a variety of ways to work it out. That depreciation is then systematically allocated to it. And the depreciable amount is cost less residual. So the cost we know, the cost of Nick's Land Cruiser, is 40,000. But we then need to come up with the residual value for it. And what residual value isn't what Nick expects to get for it in 40 years' time. And I think that's commonly seen as what residual value is. What residual value is the estimated amount the entity would currently obtain. So that's the word that's often missing is that amount would currently obtain from the disposal of the asset if that asset were already of the age and the condition expected at the end of its useful life. Which is a hard thing to do. It's like taking say it was a brand new Land Rover, taking that car, a brand new one at 2014, trying to figure out what sort of state it would be in 2054, and then saying, if you could sell this car, a 40-year-old car now, what would it be? And that's not an easy thing. So that's what's required in 116. I'm actually going to get you guys to do something, because I've been talking for a long time. There are 4 inputs there. There's depreciable amount, that's 2 inputs. There's cost, there's residual value, there's useful life, and there is the method. So we haven't talked about method, but they, straight line, some of the is digits, some other reducing balance, whatever it wants to be. So there's method, useful life, going in a completely different order now. The cost, residual value, useful life, and method. There are 4 inputs. I want you to just write those 4 things down, or even against the 4 things as they're listed there, and just write down next to it whether you think that item is more subjective or more objective. So is it something which management, I wouldn't say make up, but is there management judgment in what happens there? Or is it a little bit more of an absolute number? Now, in accounting, there are no absolute absolutes. Even cash isn't necessarily an absolute. So it's not perfect, but just of those 2, if you had to allocate them either way, which way would you go? You're happy to talk with your neighbour, although as long as you're talking about this and not what you're going to do on the weekend. But I'll give you about 30 seconds. Shouldn't take long. So just whether it's subjective or objective. What's a what one? cost, residual, useful life, and the method. Like straight line or reducing balance or. All right, let's start with the first one, the easy one, because I think cost. Do you reckon it's a more subjective or more objective sort of number? It's probably going to be more objective. Like if you've paid cash for something, you know, yes, there are other things you can get brought in, but it's generally going to be a little bit more objective. So there's not a lot you can do to play around with that number. Not to say that you can't, but it's less likely. What about the residual value? Is that more objective or subjective? More the other one. Yeah. So it's more subjective. Like it's basically management coming up with an assertion, and that's not necessarily an easy thing. So then I know you guys haven't done audit. Some of you may be working in audit firms. If you're trying to, you know, get verification of that, I mean, that's difficult to prove otherwise, in a sense. So it's one where management can say we think it's X. To say that it's not is actually quite difficult from time to time. What's the other one? Useful life. We've got a bit of a mix here on it. Subjective. How long? Okay. How long is Nick's Land Cruiser? Like, how long does the car run for?
But you can choose.
Yeah, and that's but that's the.
He's doing this from a management's perspective, not the customer's perspective.
Yeah. So that's a.
That you sell it after 5. You sell all your cars after 5 years.
Yeah. I mean, there may well be. Okay. Well, how long does a building last for? How long does a piece? Like it's. Yeah. So I mean, it's not like there's this car will just stop running, or, you know, there may well be policies where they get rid of, you know, our laptop policies, we don't own them, we lease them, but, you know, we have to give them basically every 3 years they get cycled through. So yeah, I understand there are policies where that happens. But generally that useful life, and Qantas just changed its useful life for a number of its assets. So, sorry, not just, it was about 2 years ago. And you can open up their annual report, go to the notes and see the impact, and it was actually substantial. Lastly, the method. Can they choose the method? So is it more subjective or more objective?
Subjective.
Yeah, it's generally there's a bit of subjectivity in there. So pretty much of the 4 things that you use to calculate a depreciation expense, one of them is quite solid. The other 3, there's some flexibility there. And that means they don't even have to be all that biased. You don't have to be making anything up. You can just change your estimates a little bit, and that will suddenly have impacts on the bottom line. And companies can and do change those estimates. But as long as they're disclosed, is there necessarily a problem? You can go to the notes, and I've done this with Qantas, you can go to the notes and you can see the impact. And you're talking substantial impacts compared to their bottom line. Then this gets into a behavioral thing. How many people do you think then go and have a look at the notes and build them back in? Maybe a few people, maybe the analysts, I would really hope that they do. But most people just look at the bottom line profit and trend that over years and then not take into account all these other things. Now we're starting to get into changes in value, which I think was kind of driving at your point. So there are 2 ways of dealing with this. There's the impairment method, or the impairment of the cost model, and we can revalue assets. We're going to do this method first, so revaluing assets, which is a bit strange because pretty much most Australian companies don't revalue assets. Most Australian companies actually just go with the cost model and the cost model alone, but we will have a look at it. So the revaluation model is the choice that you make under paragraph 29. And if you go down this route, this is what gets recognized and this is what you show for your assets. You start off at fair value, you take away any depreciation which is there, and you take away any impairment losses which are there. Now for us, there are a couple of comments I need to make. One, we are not doing revaluation and impairment combined. In reality, if you're doing the revaluation model, there will be impairments laid over the top. For us, what we're doing right here and now, we're segregating those items just so we can see the differential effects. It just makes it a little bit easier to work through. The second comment is, for those that have done ABC or are doing ABC, you will see revaluations and you will see impairments. You also see tax effects of those. We don't deal with tax effects until we look at tax effects in week 9. Or week, no, it's too early, 11, whatever it is. So there are no tax effects in this. So for those that are doing ABC right now and that seems to just be a little bit inconsistent, I apologise, you're just going to have to remember where you deal with tax and where you don't. If you've got this in front of you, circle that. The starting point for the revaluation model is fair value. So whenever you do a revaluation, so whenever you start on the books, the starting point and then you take things away from it is fair value. Think about how that differs from what we saw with inventory. When we have inventory, it's cost versus net realizable value. If cost is the starting point, you can be lower than that, you can have write-offs. You can't be above the initial cost. Fair value, if you bought a piece of land for $1 million and that land was now worth 10 million, you can go up. That could be 10 million. You're not limited to what you initially paid for it. So how often do you need to do it? Just enough that your books basically stay in line with fair value. So what is fair value? There's a whole standard on fair value. It's a pretty new standard, but the reason for it is there's that many places where fair value gets talked about. They figured, well, we actually need a fair value standard, so they created a fair value standard. So what it is defined as is the price that would be received to sell an asset in an orderly transaction between market participants at the measurement date. So we looked at that last week. So moving on then, valuation techniques used to measure fair value shall maximize the use of relevant observable inputs and minimize the use of unobservable inputs. So we need to have a look at what these sort of inputs are because they do have important differences. So let's have a look at level 1, level 2, and level 3, and let's have a look at some examples. So level 1 are quoted prices in active markets for identical assets. So what is you guys are all business students, what is a good example of something that would fit as a level 1, where you could get level 1 prices for? A car? Even with options, they're probably not absolutely identical. What is something that you could trade? There are markets for it. There are shares. Absolutely identical things. So you can trade, I mean, obviously there are different shares from different companies, but companies will have millions of shares. They're identical. They get traded. You can see the price from, I hold Woolworths shares. If I want to know how much they're worth, I just open up the papers, show my age, or I could look online and I could see how much that they're worth. So in terms of reliability, that's pretty good. That's like, there's no management kind of making stuff up in that. That is something completely independent. Level 2 are inputs other than quoted prices that are observable for the asset. So it could be quoted prices for similar assets, and I think that's where cars start to feature into this, because you go to a car yard and they'll all have different options packages and different things, and they're not going to be absolutely identical. I mean, you may come across a few which are, but it's unlikely that's going to be the case. So cars are a good example of that. Houses are a really good example of that. Apartments. There is only, even in a part, there's a new apartment block, actually there's a few new apartment blocks going up around here. But even if you look at the one just opposite the library, which is opening pretty soon, there will be a number of studios and 1 bed, 2 bed. There'll only be a couple of penthouses and whatnot. But even say there's the 2 bedrooms, and let's just say that all have exactly the same layout, but they're not exactly the same because one has to be in a different place. One will be on one particular floor, another will be on a different floor. They will be slightly different. Not massively different, mind, but just they won't be exactly the same. So if one of them sells, that price for that one will probably give you a good indication for the price of the other. If you've got 2 houses on the block, exactly the same design, again, they're a little bit different because they're in just different places. But if one sells, that will be a good indication of the price of the other. Not quite as good as level 1, but you're still pretty happy with that. Level 3 inputs. Now this is where it starts to get a little bit problematic, and some people and some commentators have argued this doesn't really feel like fair value now, because this idea of fair value is kind of this like independent thing, an independent pricing for this asset. But what this is unobservable inputs for the asset, which is pretty much saying management is doing internal calculations and they're coming up with their numbers, or maybe they've used consultants. Speaking of which, just want to show you something. If you've been following us on Twitter, I put this up yesterday, but here, you may have been reading about if you read the Herald, this turned up yesterday. So the West Connect advisor engineered traffic numbers on Lane Cove tunnel disaster. I won't read the whole thing because it's quite long, but the thing I wanted to read, in the opening day of a trial that is anticipated to run for 10 weeks, Justice Michael Pembroke heard that Parsons Brinkerhoff reverse engineered traffic forecasts for the Lane Cove tunnel to fit the needs of the consortium that hired it. So basically they weren't going, let's figure out how many people use it and then work out our calculations and say this is what we think estimates are. They went kind of what do you need the numbers to be, and let's work out our estimates and let's work out our inputs based on that. It's hard to necessarily trust inputs into that process when you can't see it, because I don't know exactly why they made their forecasts like that. But you could argue there's maybe vested interest. Maybe if they didn't do that, they wouldn't have got the job. There may be commercial pressures to do these things. I don't know. But when you're starting to talk about internal estimates, it starts to become a little bit trickier to rely on them as strongly as external valuation metrics. So as I said, that link is available, and all those pop up on UTS Online, so you should be able to see them there. So how do we deal with this? So with revaluations, if you have an upwards revaluation, let's just say, so we have an asset, we bought something for $1 million and it's gone up to value to 1.5. That asset, we have to do it to fair value. So we take the asset up, it goes up by $500,000. We don't take that change to any sort of profit. We take it to revaluation surplus, which is an OCI account. So it actually misses profit. If it's going the other way, we do take it through to profit and loss, so we do take the hit for it. If we reverse this out, and I'm about to draw this up to hopefully make it a little bit more clear. If we reverse it out, we have to actually go through what we just did. So let's have a look at this. Okay, so we need to look at impairments now. Okay, so impairments. Impairments in some ways is similar, but they're a little bit different. I don't know why it does that. It's kind of weird. I'll have to, yeah. After recognition as an asset, an item of property, plant, and equipment shall be carried at cost less any accumulated depreciation and any accumulated impairment losses. This is the method most companies use for property, plant, and equipment. It's like 80% of companies, something like that. At least from the research that I was saying. Cost, less accumulated depreciation, less accumulated impairment. Look what's the same, this and this. The thing which is different between the methods is the starting point. Under the revaluation model, you start with fair value. So that could be you've got land, you bought it $1 million, it's now worth $100 million, you can take it all the way up. If you have land for $1 million under impairment model, under the cost model, if you bought it for $1 million, the most that land can ever be on your books is $1 million. Even if it is worth $100 million, the most it can be is $1 million because that's the starting point. So we actually have a whole separate standard for impairment of assets because quite a number of different assets actually get impaired. So they figured rather than deal with this situation in each standard, they went, well, just revert to here and look what you do with it. So to determine whether an item of property, plant, and equipment is impaired, you apply 136. Now, the way that we do this is we look for indications of impairment. And then once we've done that, then the number crunching comes. So we don't just go and work out this number, this recoverable amount, which we don't even know what it is yet. We haven't defined it. We look for indicators first. An entity shall assess at the end of each reporting period whether there is any indication that an asset may be impaired. If any such indication exists, the entity shall estimate the recoverable amount of the asset. Now, before we have a look at what the indicators are. And look, I know they're on your sheet in front of you. Bless you. I want to show you a short video. I want to ask you some questions about it in a moment. So what this video is, I didn't take it. This video is someone driving through the Cross City Tunnel in a taxi. They put it up on YouTube. It's got about 9,000 views. I don't know why. I don't know what people do in their spare time. The internet's a funny place. People wearing onesies, people watching people drive through tunnels. What do you, apart from just obviously the quality right at the moment, what do you notice about the video?
The lack of cars.
Yeah, the lack of cars. Has anyone driven through the Cross City Tunnel? Actually, more people. I think I've driven through twice in my life. And generally, it's been a really good run both times. Like, there's just no one on it. And you may have had the same experiences, generally speaking. Yeah, like it had some problems early on. I mean, they tried to block streets to force people into it, and then people started just running. There was a bit down near Woolloomooloo where they tried to put a diversion in, and everyone just drove over it. Which is and then they just went, okay, that's not working. They got rid of the diversion. How do toll roads make money? By
Getting as many people.
people to drive on. Yeah, cars driving through it. So if no one's driving through it, they're probably not making an awful lot of money. And that's what happened to the Cross City Tunnel. It got, the owners of it wrote the thing completely off, down to zero. They just went, it's not worth anything. It was, but from an indicator of impairment, the fact that no one is using it is, and so you guys are, at least some level aware of what we're about to talk about. It's not something completely different. So in terms of impairment of assets, there are external and internal sources. So external sources, just the thing that you hold, there may be market for it and that thing has declined. I'm going to turn that off because it's doing my head in. There might be changes in technology. I would say how many of you listen to vinyl, but vinyl's had a little bit of resurgence. How many of you listen to tapes? What's a tape? CDs even. CDs, yeah. You have an actual, oh no, not Walkman. Do you have a Discman?
I have a Discman, yeah.
I found my old Discman. It doesn't work at all. But look, those things were really popular for a time. The way technology has changed means that no one really buys these things anymore. So the production equipment for CDs, the production equipment for tapes, has probably declined in value because they don't need them anymore, at least in the quantities that they used to. So that's an indicator something's going on. Market interest rates may well have an impact on, potentially on what's going on with your customers. It may have an impact on other aspects. We'll talk more about this one next week. If the carrying amount of your assets is greater than the market cap of the company. Obsolescence or physical damage. Nick's taken his Toyota and just run it against a wall. Because you don't have a license, do you? No, you don't. So that's why he's running against a wall. So if he's damaged it, that's probably an indicator that there's something wrong with the thing, or the car. I shouldn't say thing. If you don't use it, or maybe there's a problem there. If internal reporting, I'd imagine that there'll be internal reports for the Cross City Tunnel saying, yeah, there's a problem with this. So however you get those sources of information, if there is some indication that there is a problem with this asset, you then go to the next step, which is what we're about to look at. And that is to calculate a recoverable amount. And how you do this is, well, actually how you define it, is the higher of its fair value less cost to sell and its value in use. So imagine, I think we talked earlier about how you make money from houses and how you make money from shares. And you have shares, you make dividends, or you can sell it at the end. From houses, you could, maybe we didn't do houses, but houses you can rent out, or you can get the capital gain when you sell it. That's in effect what we're seeing here. So if you think about recoverable amount is what you could get for selling it, that's the capital gain. You have a piece of property, you could sell it, and you can realize some cash for it. Or you could use it and you could keep renting it out, and that will give you a certain number. because you'll work out what you can rent it for over the next however long, discount cash flow, come back to a number, and that is the value in use. Now, the development opposite the library, the new one that's nearly complete, not the Geary one, the one where the apartments are going up. Have you guys been here long enough that you saw the car park there before that started? Okay, so that's a good case where there's going to be a difference in terms of the value in use and the fair value less cost to sell. Because there's a car park, say it could get, I don't know, 100 cars in a day. So then you go 100 cars a day at $10 a day. So you've got $1,000 a day, 5 days a week, $5,000 a week, 50 weeks, $250,000, using a 10% into perpetuity. The value of that in use is about 2.5 mil. That's some pretty ballparking figures. Just for argument's sake, that's the value in use. But as to a property developer, that's probably going to be worth a lot more than 2.5 mil because you've just seen what they put up. I went and had a look at the display studio, the display apartments, and they're expensive. And they were 80% sold before the site had even started work on it. And they were not, like, one beds were like 800 or something. It was expensive. Anyway, so there can be a difference. Now think about it from a cross-city tunnel point of view. Is there a market for these things? Can you pick up the cross-city tunnel and put it somewhere else? No. So the only way you're really going to get a fair value for it is the cash flows it generates. So in some cases, fair value and less cost of sell and value in use may be the same. Some cases they may be different. Anyway, so you've got a number. If that property down up at the library was 2.5 to use and 10 mil to sell, which number rationally would the owner use? They'd use the 10 because that's what a rational person would do. So they use the 10, you take that number, that's recoverable amount. You then compare it to what it is on your books. If it's on your books at 12, you've got a problem because it's carried it too much. If it's on your books at 8, that's okay because that's fine because it's higher. So you're looking for, is the recoverable amount higher or lower than the carrying value? If it is lower, then you have an impairment. If it's higher, if it's higher and there hasn't been a previous impairment, you don't do anything. But we'll get to the reversal in a moment. You have an impairment and you write it off. If there are indications that the conditions leading to the impairment have decreased, much like if people start buying onesies again, if people start driving through the cross-city tunnel, probably indications that they're generating more income, probably indications that you can redo the calculation. You redo it, you come up with a new number. And this paragraph 117 is really important. And we'll look at it in a moment. The increased carrying value of an asset attributable to a reversal of an impairment loss shall not exceed the carrying value that would have been determined had no impairment loss been recognized previously. That is an important situation. And we're going to have a look at how that works out. One final comment. And instead of really looking at the regulation and going through the slides, quick comment around borrowing costs is when we looked at inventory and we looked at property, plant, and equipment, and we looked at the idea about cost is all the costs that you need to get that thing to where you want to use it get included in the asset. If I want to buy a house or an apartment, and I pretty much imagine most of you in this room, they'd be in the same boat. I don't have cash just sitting on hand and go, hey, I don't have that much money. So it means I've got to borrow money, which means the only way I can get that asset is by borrowing money. So you could argue the interest costs are actually a critical part of the purchase. And in certain situations, if you can capitalize borrowing costs that are directly attributable to the acquisition, construction, or production of a qualifying asset. Borrowing costs, pretty straightforward. A qualifying asset is an asset that necessarily takes a substantial period of time to get ready for its intended